Welcome back. This is Chart Overload. Appreciate you joining us. I'm Ryan Mumy, the CEO of Sollinda Capital Management. This is my partner, Justin Greenhill, our Chief Investment Officer. Justin, kind of like Where's Waldo? Where are you right now?
Drexel, North Carolina.
No, you're not.
I believe Rio de Janeiro, Brazil.
It's always good. Always good to find out where you are. But let's go ahead and get started. This is getting right into the charts. Big picture. The government shutdown is back on the headlines. We've been here before. What are our thoughts here?
Government shutdown. It's that time of year. It's like reverse Christmas. This graphic just simply shows that, the more recent shutdowns last longer. And the Trump administration is, sending out the forewarning that if it does shut down, there could be job layoffs, so on and so forth. So we have to assume they'll save it at the last minute, but, we'll see.
To be determined. But in the past, there's been some blips, some volatility that's entered the market when there's been shutdowns. So we will continue to monitor. Next one, looking at GDP, and it surprised many with the revised move up.
Yeah, and this has been the big thing for several years now. Is despite there being some weakening in certain economic indicators of the labor market, etc., overall, relative to many places of the world, U.S. economic growth continues to power ahead. So, people said during Biden it was because of government spending, and now that's softened, and the private sector seems to be picking things up. So worth noting.
As we've shared, the CapEx alone from the technology sector is pretty remarkable right now. And that's real money going into the economy. This next one, the other side of the equation is the Conference Board's leading economic indicator is once again flashing recession. But is it Chicken Little because it flashed recession? What was that, last year?
Yeah. One thing to note here, first let's look at the first chart. You can simply see that historically this leading economic indicator has had a pretty good track record at predicting what has become recessions, but let's go ahead and move to
often with a lag.
Often with a lag.
The next chart.
Yeah, connecting
the next chart looks at specifics.
The specifics, right. And what you see is the things that are making it negative now are so-called sentiment indicators by and large. So you've got a scenario where, whether it be tariffs, whether it be the fact that up until recently we had higher interest rates, there is the so-called soft data or expectation data is weak. And although that can forewarn a negative, it can also mean that can now start to become positive again, on a rate of change basis.
Yeah, and digging deeper, if you look at the 6 months ago to now, you're also seeing some of that, the order data flipping positive, to your point that sentiment data is soft, but there is some non-financial components that have flipped to neutral to slightly positive.
Right.
Next chart looks at, we've looked at this before, looks at foreign held U.S. equities as a percentage of foreigners' financial holdings, and we're clipping all-time highs.
Yep, and if ever there was one chart for a international focused mutual fund to put, in their prospectus, it would be this, because, it just, one could simply say that if all these foreigners start to just rebalance their portfolios, that obviously means a lot of money comes out of U.S. stocks and goes into, non-U.S. stocks. But recalling back our last chart overload, when we talked about how U.S. stocks represent roughly 70% of global stocks in terms of market cap, but a much smaller percentage of revenue. All this international money is not buying the U.S. stock market because it has an opinion. It's buying it because it needs to track the index, and that is the index. So this chart's a bit tongue-in-cheek in that it means something, but this is not something you want to mean revert, let's say.
Yeah, you can't really act on it. It's good to be aware of it. Moving into domestic stocks, first chart just looks at how the S&P 500 is trading relatively to the two largest cryptocurrencies, Bitcoin and Ethereum.
Yeah, this is the chart for those really annoying people on the internet who talk about how crypto is so differentiated and uncorrelated. As we can see, it basically in a risk-on environment moves one for one with the stock market. So having said that, we're starting to see a bit of divergence. So we'll see if that correlation holds. But this year, whether you've owned Ethereum, Bitcoin, or the S&P, depending on your sizing, you've moved in the same direction both ways.
Correct. And we talked about this. We just looked at the Qs at the NASDAQ relative to Bitcoin, and that's been a couple years ago looking at that. So this is just confirmed that for all the non-correlation talk, that hasn't really panned out in price action. Next chart looks at the S&P 500 relative to its equal weight component in their rolling correlations.
So what's interesting is we just said Bitcoin and Ethereum are positively correlated to the S&P 500 market cap index. Interestingly here, what this shows is that the S&P 500 equal weight, which neutralizes the size of the biggest companies, actually has a historically low correlation to the S&P 500. So a lot of things that kind of seem nonsensical to history are true in the markets for the time being.
Really interesting because it's the same companies. The only difference is the weighting. And
the same index, not even just the same company.
Yeah, it's
same thing.
Right. Next, small caps. We've talked about them. Even in our first chart overload, we mentioned how, look, if the economy is going to expand, there's probably going to need to be more participation. Well, we've had more participation.
Starting to get it. So chart here just basically shows that even though the mega cap indices, NASDAQ, S&P 500 have been at all-time highs for a number of months, the small cap Russell 2000 is just now getting there.
Just now getting there. That second chart, if we move on, it shows how long it's been since all-time highs, and it just clipsed going back 25 years, its longest time frame, 969 days.
Yeah, long time, years.
Next chart, this gets lots of press. Forward price to earnings ratios, and they're clipping lofty levels. The S&P, the red line, the next time it's been as high as it is right now is back during the tech bubble.
Yeah, and there's been so much thought spilled on this, but I guess at the end of the day, the big stocks have higher fundamental ratios than they've had in the past, and it's impossible to know if that precedes smaller forward returns, like history would say.
Well, and what everybody's missing is, unlike 2000, the dot-com bubble, tech companies now are printing cash, right? They're actually making money. So while the dot-com bubble was driven by lofty valuations, the companies had very little revenue and virtually no earnings. And the Mag 7 today looks much different in that they're making money. They have positive revenue. So again, but we still have to be aware of this. It's just to what you said about the foreign ownership of U.S. assets. You can't necessarily say that's it, make a decision. In a counter to that argument with our next chart is this shows assets in money market funds. That's also at an all-time high. This is money not actively invested, just sitting in money markets.
But could be invested, hypothetically.
Correct. That's the thing. Yeah. It could be. Does even a chunk of that get rotated into equities? Then most likely it will go up. And this next chart is, again, despite the lofty valuations and anything else, volatility remains very low.
Yeah, this is a really great chart because the people that follow the VIX, which is just, the standard volatility index, would say it's relatively low. But if you look at this chart, it's actually still high relative to how little the market is moving day to day. So all that simply means is that, if it's going to take more movement in the market to get volatility moving, frankly. And, we've seen a little bit here, this week relative to maybe the week prior to that, but still not very much.
Yeah. And again, it's just back to anyone that takes one chart and tries to tell you this is what's going to happen. Oftentimes they have an agenda, and newsflash, your best interest probably isn't it. Let's move on to non-U.S. stocks. First chart, old Alibaba. It's been on a ripper.
Yep, Chinese stocks have caught in the AI fever with communist influence. And, AI would probably do very well in communism because they could really get behind the build out. I mean, there's no CapEx bust.
Yeah, I was going to say CapEx, right? There's unlimited funds to build it.
And zero care whether it works well after, right? I mean,
yeah, what it does and what it's using it for, probably we wouldn't get behind that, but building it out and getting something, there's going to be endless money. Moving on, Brazil. Brazil is moving rates, I guess, in a little bit different fashion than the Federal Reserve.
Yeah, to say the least. So, Brazil basically is one of the countries that was first to raise rates, after the pandemic, and has now been really the last, actually, of the major economies to start cutting rates. So interest rates still sit at about 15%, which, as we've seen here recently, is slowing the economy, but it's also strengthening and really stabilizing the currency, just because, when the U.S. is cutting interest rates, it's hard to want to bet against another currency that you have to, at this point, basically pay 12% a year to short.
Yeah, right. You better be right, or
hedge funds don't like that. You better be right, and you better be right quickly.
Yeah, that's good. Next chart just looks at a ratio to the broad international stock index relative to the S&P 500 going back 15 years.
Yeah, so as we can see, non-U.S. stocks have gone straight down relative to the S&P 500. There's been a bit of a bounce off the lows this year, but at least for now, that's started to roll over yet again as the big AI stocks continue to gobble up all the world's money.
Yeah, I mean, we've talked about this, that everybody, every news headline was international, and we said, well, zoom out a little bit, and the chart really hasn't moved. This chart really hasn't moved, but if you shorten it up, it looks like a massive move. And again, from a historical standpoint, yes, they've been in favor relative to the U.S. for some of this year, but will it continue? Who knows? And we could be singing the national anthem here. The ball game hasn't even started. Or, it could be extra innings of the U.S. outperforming.
Or the seventh inning
we don't know.
And it's not, and it'll start outperforming again because,
right.
Global flows like to come to it's easier for global money to come into the U.S. than it is for global stock market money to leave.
As we saw in the foreign ownership one, right? Same deal.
Same deal.
Moving on to interest rates, the old bond market. This first chart looks at the two-year yield.
Yep, 2-year yield went down big into COVID. Went back up a lot really fast in 2022, and since then, really 2023 to now, we've just been seeing modestly lower interest rates pretty much year for year. So
and this most closely tracks what the Federal Reserve's doing.
Right, correct. Yep, should have said that. Next chart here.
This here for you.
Yeah, you're here for me. You always have been, always will be. That's when. And we're here for the audience.
Yeah.
Next chart. I think this is interesting. This is, I believe this is the Federal Reserve Bank that took a bunch of PhD economists, a bunch of different factors, analyzed it in infinite different ways. And what they've come up with is that the Fed funds rate is probably going to be between 1.5 and 3.5%. Thanks for coming out.
So we have all these people sitting around making lofty big arguments for big projections, and they analyzed the data and they basically said, here you go.
Yeah.
It's good.
So
next chart, looking at the longer maturity bond yields, just looking since late last year. And there's been some volatility there.
Yeah, volatility and not a lot of direction. So, if someone would have held this security, call it 20-year plus treasuries, you've basically made, let's just call it around 4.5% or so, but you've, had your capital move in 10, 12% in both directions, and it hasn't really gone
right
there. So
you're collecting the coupon, but your principal's jerking around quite a bit.
Right, which is not good for what a lot of people are looking for when they buy government bonds.
Fixed income, more stability. Next chart looks at spreads between investment grade corporate bonds and treasuries. And we got this from Bloomberg, but as you see, and they clearly state, it set a new 27-year low.
One of the schools of thought around this right now is similar to how certain flows are making the valuations in stocks higher than they have been historically. One could argue that the same flows, balanced portfolios, IRAs, 401ks, etc., is actually making credit spreads tighter or investment grade corporate yields lower than the fundamentals might imply. So the same, so-called distortion, no negative connotation intended, is relevant in the bond market today as it is in the stock market domestically.
Yeah, because these spreads is the difference in yield between these corporate bonds and treasuries. And, that risk premium, sometimes they're called, is how much above the risk-free rate of U.S. treasuries are investors demanding for allocating capital to these slightly riskier investments. And the answer is not very much. And again, does it mean something? I mean, ask me about this day 6 months from now, a year from now, 2 years from now, and I'll tell you. But it's hard to make a call because of the confluence of data like Justin talked about. There's other factors at play beyond what there has been in history. A lot of money chasing a universe of securities. Moving on to commodities. The Goldman Sachs Commodity Index, it's been sideways and hasn't done a whole lot.
Sideways for really 3 years or so, starting to perk up. Obviously, oil is the biggest component of this commodities index, which if you go to the next chart, oil has basically been languishing, but potentially could be bottoming here, albeit with there's a pretty negative outlook by the market in terms of supply, just simply meaning that when oil prices go up, there's a lot of production ready to come onto the market and try to make that money, be it from Russia or Brazil, etc. U.S. Production as well.
Yeah, and we've been talking about oil consistently as it's broke through the resistance levels, support levels, and now that same level has become resistance to it moving forward. But as we've said, you can't just trade oil based on charts. There's, to Justin's point, there's so much weight on the supply demand mechanics. And then the last last chart looks at the metals component of commodities, which those have done better.
Yeah, and led by gold. So this is gold, copper, and silver, which you can see, going back a few years and historically as well, longer term, they're very positively correlated, which they have been. But now you're seeing that in the top right of the chart, gold and silver are breaking out to new highs, and copper, after a big correction that I think we
spent some time on.
Spent 2 different shows mentioning, and have talked about it internally as well, is now starting to catch back up. So, typically they tend to move together, and in bull markets for metals, you're often better served buying the recent laggard, especially if there's a situation that would be logical as to why one has lagged and may not lag. And
it's not a recommendation. That's an observation of history.
Yes. Thank you for that.
And final chart to just look, gold's went up and lots of retail folks are buying gold ETFs.
They are, and gold went up for a while and they weren't. So this is something, kudos to Mr. Ryan Mumy here for pointing out over time. Trying to identify when retail is piling into gold has historically been more valuable in predicting the risk reward to gold relative to trying to analyze when retail is piling into the stock market, for example.
And it's back to, why do we say that? We don't say it tongue in cheek. We show the evidence that may be getting flashed out there, and we present a balanced argument that you can't just point to one thing and make a big call. It oftentimes doesn't work that way. Maybe you're right, but oftentimes just as much you won't be. But that's why we do this. We give our flavor, and we appreciate you spending some time with us. We know you could spend your time a lot of different places, and we appreciate you spending it with us. We hope you gained some knowledge out of it, or you giggled a little bit. And if you have any questions, you want to dig deeper in any topic, we're an open book, happy to have some civil discourse, if you will, talk through it. Phone number is 844-662-1211. Email address is info@sollinda.com, info@sollinda.com. Until next time, we appreciate it, and we hope you have a great week. Thanks.
Thanks.